Okay, this next part we're going to talk about the schemes or the ways that we have of
determining how much inventory we have and how much we've sold and some of those kind of things. We're going to assume what's called a perpetual inventory system, which we introduced you to in Chapter 5. That's where we always keep track of our inventory accounts. When we buy inventory, we add it to merchandise inventory, and when we sell it, we take it out of merchandise inventory, right? So we're going to use a perpetual system in all of our examples, and this follows the matching principle, right? Because matching says we match expenses to the period that the revenue was produced. Now, it's important to remember, on the balance sheet we have an asset account, right? And that asset account is what? Merchandise inventory, right? And on the income statement I have a cost of goods sold T account, right? That's an expense account, right? The expense account that deals with inventory. So what we're doing in these ways, these things that we're going to show you here in just a little bit, is we're making determinations, right? We buy inventory and then we sell it. Well, we don't always buy our inventory at the same price, so we have to make some choices about how these costs flow through our system. There's going to be 4 different ways that we talk about this process. So we're really allocating, right? We're allocating between how much of this inventory remains on our balance sheet and how many dollars of this inventory are transferred to our income statement in the cost of goods sold section, right? So these 4 methods that we're going to talk about. This next slide deals with these 4 methods, right? So we're just going to look at this. We're going to look at this just like that for right now. Now you'll notice there's 3 things: FIFO, LIFO, weighted average. The 4th one, specific identification. I don't know if I spelled that right. It'll work. So we have these 4 ways of doing things. First in, first out. Costs flow in the order that they're incurred, right? All we're doing is we're deciding when we sell something, how am I going to make the choice about which one am I going to sell? And this tells us specifically, right? First in, the first one that I bought is the first one to go out the door. Next one is what? Last in, first out. That's also very descriptive. That means what? The last one that I purchased is going to be the cost that's assigned to the one that goes out the door, right? And then we have a weighted average where we just keep a running weighted average of the cost of each of our items of inventory, right? And the 4th one is specific identification, where we specifically identify which of the items were sold, and then we specifically know which ones are remaining in inventory. The next set of videos, we're going to go through specific examples of each of these things, right? But let's just talk about it conceptually a little bit right now. Let's say, for example, we're going to deal with this separately, right? But and this one too. Let's talk about FIFO and LIFO. So what we've done here is we have bought what? We have bought 3 different items. One for $45 on the 1st of May, one for $65 on the 3rd of May, and one for $70 on the 6th of May, right? So we bought those 3 things, and no matter how we're doing this, we're going to deal with those same 3 items, right? And it's the same process all the way across. First in, first out says, if I sell one of these, what is the cost of my sales, right? So if I sell it for $100, right, there's my net sales. Well, the cost of goods sold, I'm going to go where? To the first one. So I look at the earliest one that I bought. My cost of goods sold is $45, right? 100 minus 45 means my gross profit's $55. If you look at how much is remaining in my inventory, how much is on the balance sheet, that's $135, because I still have what? I still have those 2 units in my inventory at $135, 70 plus 65, right? $135. LIFO, last in, first out. Cost flow in the reverse order, right? So I sell it for $100. Now I'm going to choose the cost that's the most recent, right? The May 6th cost. So 100 minus 70 is the $30 of gross profit, right? But we costed this at how much? $70. Now my inventory is made up of what? The oldest stuff, the $65 unit and the $45 unit. So my ending inventory is $110, right? Now this doesn't have anything to do with the goods flowing out our door. These are costs that we're assigning to these as they're sold, right? So people come and they buy something from me, and we assign a cost to it as it leaves our store, right? So that's FIFO, that's LIFO. Weighted average, I do what? I take all three of them and I average them, right? 70 plus 65 plus 45 is 180 divided by 3. That means what? $60 a piece, right? If I sell one of them, my cost of goods sold is how much? $60. I have 2 of them remaining, so my remaining inventory is $120, right? We're going to go through examples of all 4 of these. This doesn't work as good for specific identification because this is which one did you sell, right? Things with serial numbers, that kind of stuff is where that comes into play. So the next set of videos, we're going to go through examples of those 4 things, and that's where we will pick it up.